Why I don't trust fund managers with my pension, or for that matter, IFAs or wealth managers. Here are 3 reasons. Save this for later, and I've got some data to share with you. According to S&P SPIVA, 94% of UK managers, fund managers, underperform over 15 years. That's 94% over a lesser period of time. The numbers are still shocking, and basically the odds are highly against you that the fund manager is going to outperform the basic index. Again, they're going to charge you fees for that, and they're going to justify those fees on a billion different ways, which I think are quite unjustifiable. So here are 3 things that you need to know. First of all, the SPIVA report shows that over 15 years, 94% of active UK fund managers lag the FTSE benchmark that they themselves are setting for themselves as a benchmark. Even in the US, 85% of large cap fund managers fail to beat the S&P 500. So simple ETF tracker with a fee under 1% seems to be an obvious thing to do, you would think. 2, well, the other reason I don't trust them, why? Because they charge high fees, okay, compared to ETFs. They are, after all, closet index trackers. Why are they closet index trackers? A typical fund manager will find a benchmark, look at what the benchmark is composed of, and say, well, we'll have a little bit of this and a little bit less of that one. Now, the reason that's a problem is because they're actually tracking an index to try and beat that benchmark. And they think, oh, I think Apple will do a bit better, Microsoft will do a little bit less worse. Well, we know from the data that approach simply doesn't work either, okay? The killer for me, they don't get sacked when they underperform. Time and again, they simply don't get sacked. So they might move on to a new firm. But really, the few that do get sacked, as it were, it's never written down that it's for underperformance, so they just go on to damage somebody else somewhere else. Third reason, when I pick stocks myself, well, I'm using, if I want free tools, Yahoo Finance, Google Finance, you can use these yourself if you wish, and pay a bit for a few other things. But I can keep the fees near zero, whether it's a free trade or a broker offering very low cost. But this is the other thing which is really good about doing it this way. An exchange traded fund under 1% fees, of course, performance is the important thing, but it's pretty easy to outperform those kind of fund managers, but you can keep the brokerage fees down, probably a lot lower than those funds are charging you through their fund structure. You just don't know you're being charged for it because it's all hidden in the costs of running the fund. Okay. It also allows me greater freedom because it's not a black box. I know what I own, and I know I own it, and I'm happy to own it. I'm not saying to